Hey, what's good guys? Hope you're all having a great week. Today's video, we're going to be talking about leverage. Now, I know this topic and word gets thrown around so much in the Forex community. And the reason it's primarily just the Forex community is because in stocks, you don't really have access to a crazy amount of leverage. The most you'll usually ever get is like double, so 1 to 2. So really it's not an issue. The reason Forex gets such high amounts of leverage is because, one, it moves a lot less than the stock market. So you sort of need a little bit of leverage to make the money and the profits that you need. And two, brokers, a lot of them are betting against their clients, and also they get commissions. And so really, it's in it's in the broker's benefit, no matter how they operate. Either they're taking the opposite side of their clients' trades, or they just are getting paid on commission. Either way, they make more money the more size that you trade. So they make a lot more if you're trading a 1 lot or a 10 lot versus a micro lot or something like that. So it's in the broker's interest to give you as much leverage really as you want. That's one of the reasons why it's sort of gotten out of hand, and they'll give you unregulated brokers will give you 500. Some of them will give you 500 times your money to trade. That's just insane. That's like a couple pips, and your account is blown. Yeah. But anyways, we're gonna be talking about how much leverage do you actually need? What is a good amount of leverage to be a consistently profitable trader? Make enough money but not risking too much. How much leverage do you need? So really, this gets thrown around. So many people ask, how much leverage do you need? How much leverage does a broker have? How much leverage should I use on my trades? So much going around leverage. Honestly, I'll tell you guys my opinion towards the end of this video. We're going to get into the math on the computer. We're going to talk about actually how much leverage do you need to consistently trade, not blow your account. And this really gets thrown around partially because of the debate between regulated and unregulated brokers. If you have an unregulated broker, a lot of people flock to them because they have higher leverages, where the regulated, safer brokers usually only give 20 to 50 times your money, which a lot of people think that's really low. And when we get into the math, I'll sort of debunk this and show you guys you don't need more than 20 or 50 times your money. That's really where I stand on this. You can basically use any broker you want, and you should be fine. I never use more than 5 or 10 times leverage, if that. Usually it's even less. And so let's get into the math, and I'm going to prove this to you guys, right? And hopefully end this debate, if I can, around this idea of having a ton of leverage. Because you don't. If you look at the math, we're going to get into the math in a second, you don't need a ton of leverage. And so, yeah, if I can save at least one person from blowing their account with this video, I've succeeded. So, with that being said, let's hop over to the computer. All right, guys, let's talk about leverage. So, here we are. Leverage. This word gets tossed around a ton in the FX community, and essentially, people place way too much emphasis on it, and it's not even needed, to the extent that people think it is. There's so many misconceptions about, you need 100 times leverage to be successful. That's such BS, and I'm here today to prove it to you guys. People often choose a worse broker just because they give you access to more leverage. That's the stupidest thing you can do, and I'm here to show you why. So here's the L word, leverage. For those who don't know, what is leverage? So essentially, leverage is like a loan. So your broker, let's say this little circle is your broker, and this little guy here, this is you, or girl. We'll do half and half. So that's you, and this is your broker, right? So you
essentially give them your money and put into their accounts. So it's not in your bank account anymore. It's in their account, and so that you're trading with their liquidity providers, et cetera, et cetera. And essentially, you have to give them your money so that you can trade with them, right? Because your bank and your checking account at Chase, you can't trade currencies from that. So you have to move your money somewhere, right? So they have your money, whatever. Hopefully they don't steal it. But leverage is essentially them giving you a loan. They're giving you their money, or they're giving you someone's money to trade with, right? So, for example, let's say you give them $1,000, right? So 1K. Well, so this is how much is in your account. Normally, if you were, if you had no leverage, then you would only be able to buy $1,000 worth of any currency you wanted to trade. Let's just say, to keep it simple, you wanted to trade the US dollar. You could only buy 1,000 US dollars. So your position would be, if you're thinking in terms of lot sizes, you could only trade a 0.01 lot size, and you would be making about 10 cents a pip, right? So that's how much you'd be making or losing per pip. So a lot of people would not be satisfied with that, and they want to make more money than that. And so your broker knows that people want to trade with more money, and they're fine trading money that they don't have. And so they'll give them, let's just say a normal offshore, regular old broker will give you 1 to 100 leverage. So they will let you open positions from that $1,000 that you have worth $100,000. So where are you getting this $99,000 from? The broker, or someone the broker's connected to. So they're loaning you $99,000. But their condition is, of course, they don't want to lose any money off of this loan, and so the second that the value dips to 99,000, right? Then all of a sudden they canceled the trade and you just lost, your $1,000. They didn't lose any money by loaning you this 99K. So as soon as the value dips, then you lost all your money. And it's very easy for 100,000 to turn into 99,000. And so now you're trading one lot, right, one standard lot size, and you're making or losing $10, which is 1% of your account per pip. And so most pairs, in a decent normal day will move maybe 50, maybe 100 pips. So if it moves 100 pips that day in the wrong side of your trade, we're using this full leverage here, you just blew your $1,000 on one trade idea, one direction, one pair, one everything, right? That's gambling. That's completely gambling. You're never going to see any long-term success with this or consistency. Now, how much leverage do you need? Since clearly 100 times leverage is kind of a lot. You know what? I'm going to break it down here by strategy. Maybe this will help sort of get this message across to you guys. So let's break it down by trading strategy. Let's say first we have a swing trader, right? That's basically what I do. I'm a swing trader. And so basically we're going to do this by average pips risked per trade. This is how we're going to break it down. And so basically what I want to prove to you guys is, unless, and I know very few of you are, unless you're trading with, let's say, you're scalping, like really scalping, like going for 5 pips. Most people aren't trading like that. Unless you're going for 5 pips or less, you don't need anything more than 20 to 50 times leverage. I'm going to prove that to you here with the math, right? Because math doesn't lie. So, swing trading, at least usually people risk 50 pips if they're swing trading. And so we're going to use the minimum amount risked. But, it can go up to maybe even, 200 pips you're risking per trade. But let's stick to the low end, 50 pips, right? So if you're risking 50 pips here per trade, let's scratch that. Let's say if you're swing trading, you're trading and you're risking 100 pips per trade. So let's say you're even using 20 times leverage. Let's do like the low end. Every broker out there, regulated, unregulated, if they're in the US regulated, not US regulated, whatever, will give you 20 times leverage. Any currency broker, Forex trading broker will give you 20 times leverage. So let's say you have a $1,000 account. Again, make it really simple. Again, this is you over here with your $1,000. So here is you, right? Half girl, half man, since I don't know who's watching this. And we're going to name this person Justina, right? So we don't know what gender they are. But regardless, they have $1,000. And so because they have $1,000 and their broker gives them 20 times leverage, again, like I said, almost every broker will give you this. That means you can open positions worth $20,000, right? Since they give you 20 times the amount you have in your account. So $20,000 positions, or if you think about it in terms of lot sizes, that is a 0.2 lot, right? And it's moving $2 a pip. So $2 every pip moved. Again, basic math here, 100 pips. So multiply that by 100. Man, I never thought I'd be teaching math. Oh, this feels so weird. I feel like I'm teaching math. But anyways, we're going to keep it rolling. So 2 times 100 is, on average, you're risking $200 per trade. Well, let's take this back to our original account. That is a dandy old 20%. 20%. So you're risking 20% per trade. That's unacceptable. And let me just tell you guys, you're never going to be consistently profitable and grow large accounts long term unless you get that number way down to 1% for the most part. Rarely should you be risking 2% per trade. So yeah, this is the standard that you should be risking per trade. I hope everyone sort of knows that by now. But if not, risk management is going to be one of the key things you should be focusing on if you don't know what amount to risk per trade. And if you ask anyone how to be successful as a trader, you would expect them to say, oh, or some of them who are dicks and probably don't know how to trade say, oh, well, I'm just good at it. What can I say? No, nobody's just is born a good trader. You have to learn over time and experience, and yeah. But regardless, if you ask any decent trader out there what the secret to success is, almost every time, and anyone that tells me just one single tip, and do you have one single tip how to be successful, I just say risk management or risk 1% per trade. That is the single tip, and every person out there who is reputable will say pretty much the key, or one of the major keys, is risk management. Because if you can't limit your downside very well, you're not going to make enough in upside to cover your losses over the long term. Yeah, for a week or for a month, it might be fine to over risk, but over a year or two, you're going to pretty much blow your account if you're over leveraging. So with this example, you're risking 20% per trade. That's unacceptable. You do not need 20 times leverage to be a consistently profitable swing trader, right? Cool. Hope everyone can follow along with this and understand that you don't need 20 times leverage to swing trade. I swing trade. My stop losses are between 50 and usually 150. That's usually my average pips risked. I don't need more than like 5 times leverage, if that, because I'm shooting for 100, 200, 300, 400, 500 pips in profit. So, um, it sort of works out. But let's say you're not a swing trader. I know a lot of people that aren't swing traders. Let's say you're a just day trader, all right? You risk maybe, let's say 30 pips a trade, right? So, day trader, right? So you trade days of the week. That is your job. Um, that was a bad joke, but get used to it. Um, so you're a day trader, and essentially, you're risking 30 pips on average per trade. That's great. Everything's cool. 30 pips. Again, let's just, you know what? Just for example's sake, maybe you grew an account for 2 years, and now we're talking that you have a $10,000 account. Congratulations. So now you're trading with $10,000. Maybe you made a lot of money swing trading, and now you moved over to becoming a day trader, risking 30 pips a trade with more money, just to keep things a little less boring. So you have $10,000. Well, again, let's say you get 20 times leverage from your broker. So this means you're trading $200,000, or you can trade up to $200,000 per position in the market. And this in lot sizes equates to two standard lots, right? Which means you're risking $20 per pip. So $20 per pip, right? Now, what does this mean? Well, if you're risking 30 pips, let's just do the math here, times 30, that means you are essentially risking $600 on every single trade. Every single trade you're risking $600. Now, what is that in terms of percent of your overall account size? Well, your account is 10,000. You're risking 600. That is 6%. Again, unacceptable. You should not be risking 6% per trade. And again, 20 is on the low end, right? Most reputable brokers will even give you, 30 or even 50. At least here in the United States, this is the range. 20 to 50 times leverage is what Forex brokers will give you if they're regulated, again, here in the U.S. Basically anywhere but the U.S., the regulations are a little less strict, and even if it's regulated, they might give you 50 or 100 times leverage, which hopefully you can see by now is way too much, and you never need that much for a single trade. And we'll get into a little bit more about that later on. But 6% unacceptable. Myth busted. Now, let's move on to the very last example here. If you are scalping, if you're a scalper, like really scalping, let's say you're risking, let's say you're going for 10. You're going for 10 pips, right? And again, going with 20 times leverage. So your broker gives you 20 times your money. They will loan you 20 times your money to trade with. And for argument's sake, let's say now you're trading with a $100,000 account. Oh boy. Six-figure trader alert. All right. So let's do the math here. Multiply this by 20. You can open up a position worth $2 million, right? These are not small numbers we're dealing with anymore. $2 million per position, which in lot sizes is 20 lots, which is $200 for every pip. All right. That's how much you're risking per pip. You're shooting for 10 pips. Let's do the math. Multiply this by 10, and we get 10. What am I saying? 1,000. Oh my God. Guys, I hope you know why I didn't want to teach math. $2,000. I don't know what just happened there. Let me drink some Coke here. Okay, so $2,000. You're risking. That is now, if we're looking at your overall account size, you're risking 2%. Cool, great, everything's cool. That is within sort of the limit of being okay with leverage. So, what does this mean? What does this mean for you as a Forex trader? What this means is, and I know very few of you trade this way. Unless you are risking 10 pips or less per trade, let's say you risk, or sorry, if you, if you're risking 10 pips or less per trade, then, I could see maybe having a problem with only getting 20 times leverage from a reputable Forex broker, right? I could see you saying, I can't trade that way, I need more leverage. And that's fine. That's understandable. But most people aren't shooting for 10 or 5 pips per trade. That's not their profit target. It's usually between 20 and, on average, let's say 200 pips. That's the average target for most people's trades, right? That's the average target, and that's the average amount risked in pips, right? In those ranges. Well, then you don't need any more than 1 to 20 times leverage to trade profitably, consistently. Again, like I said, 1%, 2% risked per trade should be where you're at, or even less if you want. You don't need 1 to 20. You don't even need 1 to 20, much less 1 to 50, much less 1 to 100, much less 1 to 500. Guys, do you realize, let's say you get even 100 times leverage. If you have $1,000, you're trading at 6-figure positions, right? If you multiply that by 100, you're trading a one lot. $100,000 per trade. Does that even sound right to you guys? I mean, that's just gambling. That even sounds like gambling. You're basically telling the market, I will give you my $1,000, every penny that's in my trading account, if you move 100 pips, which is very possible in one single day, by the way. So if you move 100 pips, I'll give you all the money I have. Does that not sound like gambling? I mean, it's within sort of the daily range, if not 2 daily ranges. I mean, it doesn't make any sense, guys. You don't need that much leverage. I know that there's people out there that flip accounts and they say you need all this leverage. Dude, you don't need that leverage. That's just how you give more money to your broker. And I'll do a whole separate video on that, about, how brokers are sort of shady and why they give you so much leverage and why they want you to trade so big. I'll get into that in a separate video because, they definitely want you to have as much leverage as possible. But it's not in your benefit to use as much leverage as possible. You're just, again, over time, giving your money to the markets and giving your money to the broker, and you are left with nothing, much less the millions of dollars you're probably dreaming about, right? And there's a caveat to this. I could see one other instance why you might need more than 20 times leverage. And that is if you are a trader that has a lot of positions running at the same time. So if you have 2 to 5 positions running on your strategy or more at the same time, I could see why you need more than 20 times leverage, right? Because if you're, let's just say you have $1,000 account and you get 20 times leverage, but each position, I don't know, let's say each position you're risking 50 pips. Well, in order to, okay, let's just say you're maxing out your account. So okay, so you're using $20,000 per position, which means you're risking $2 per pip, which means you're risking $100 per trade here, right? Again, that's over leveraging. That's using 10%. But on the flip side of this, let's say you open usually have 5 positions running at the same time. Well, now all of a sudden you need to use that whole 20 times leverage because each position is now $4,000, right? Because you're splitting this max amount you have up, divided by 5, you get 4,000, which is 40 cents per pip instead of $2, right? Which means for 50 pips, that is $20 that you're risking. So you're risking $20, which is 2% instead of 10%. 2% times your 5 positions, right? So unless you, if your strategy, you have lots of positions running at the same time, I could see why you might need 50 times leverage maybe. But for most average traders, 50 or 20 times leverage is plenty, right? I mean, this is even risking 2% per trade. If you risk 1% per trade, you almost never need anything more than 20 times leverage. And let me tell you guys, risking 1% per trade over the long term will make you a lot more money than risking 10% per trade. And that doesn't make sense, but it's true, because if you risk 10% per trade, eventually you're going to get in, eventually you're going to wipe out your account. It's almost guaranteed that you're going to wipe out your account if you're risking 10% per trade, and it has nothing to do with your skill as a trader. It has everything to do with statistics. Every system, even every profitable system, will have some losing streaks. That's why it's important to manage the downside. It's in those streaks. Not because you're a bad trader, not because this or that. It's because you might lose 3 or 4, maybe 5 trades in a row, even on a good system, right? You're now halfway. Your account is now half the value it once was because you're risking 10% per trade. And now you have to make 100% returns just to get back to break even. That is why. So anyways, that's basically it for this video. I hope this sort of sheds some light on leverage and why you don't really need a whole lot of it to succeed in this industry. And you should be searching for the best brokers, not just the brokers that give you the most leverage. So with that being said, have a great week, guys, and I'll see you in the next video.